All right, this is an experiment. We're going to see how this works. All right, you guys can hear me now. Yes, thanks. All right, so what we're going to do is record today's lecture, and we're going to see if we can get this up and running for the 4:30 class. Technology is always interesting, so we'll see if it works. All right, so what I want to do is start chapter 4. So what we've done for the first 2 lectures is have a little quick review of microeconomics and some of the concepts that will come back to haunt you in this course. But now we're starting the material that would be in chapter 4 or in macro directly. So today we're going to look at how do we measure output when we want to talk about output in a country. And so what we're going to do is, I just want to kind of give you the punchline so you can see the difference between micro and macro with respect to this idea of quantity. In micro, when we talk about a market, it's an individual market, and so it would be price and quantity. So we would have a story of a micro market, and quantity would be measured in like numbers of units. And price would be measured in dollars per unit. So we talked about, we could talk about oranges, we could talk about apples, we can even talk about US or Canadian dollars as if they were a commodity. Okay, so we're talking about the number of units that we're buying. And so in this market, we would say that we have producers of these units, so supply, and then we have demand, and we would have a story that says, if we change supply or demand, what would happen to the price per unit or the quantity per unit? So this is very micro as a story. Okay, in macro, this is what we're going to end up with. We're going to start talking about what we're going to call aggregate demand and aggregate supply, which means we want to talk about all the supply in the Canadian economy and all the demand in the Canadian economy on aggregate. So how do we measure that? Well, the way we're going to measure that is in dollars, in value of production. Okay, so it's going to, so quantity is actually going to be measured in money, right? We're going to talk about how much is the value of the Canadian economy, and where we're heading to today is we're going to talk about gross domestic product. Gross domestic product is measured in dollars and cents. So we're going to measure output in dollars and cents, and in terms of price, there's no price per GDP, right? How do we get to a price per GDP? So we're going to get a sense of how prices are changing using, on this axis, a price index. Okay, so there's 2 price indices that we will spend a lot of time on in this course. So maybe many of you would know at least one of them. Can anybody think of a price index that's kind of famous? The Consumer Price Index. So the Consumer Price Index, and so we'll look at how do you create indexes or indices? How do you do that? And it turns out a price index has no units. It's just a ratio. It's a ratio around the number 100, usually. So we would have the number 100, and if it's bigger than 100, it means something, and if it's less than 100, it means something else. So we're basically going to have a unitless number, and it's going to be some sort of measure of prices overall in the Canadian economy. And then we're going to develop what are called aggregate supply and aggregate demand. So what we need to do in order to get to the modeling part of the course is we're going to have to develop these numbers. So today's lecture is going to be how do you measure GDP, so the value, so this is going to be real gross domestic product. So that's what chapter 4 is all about. How do we get to this concept of how much stuff was made in Canada and what's it really worth? Okay? Anybody have any questions before I move on? So it's kind of the transition we're making. We're going from micro into macro, and in order to get into macro, we need to develop some data, some ways of measuring what we think is important to measure. So we're going to look at real GDP. Well, when we say real GDP, it actually means something very specific. We're trying to say this is how much this stuff is really worth. And the problem is because we're measuring things in money, what happens to money over time? So let's say we have, this year we're going to measure gross domestic product and we say it's $100. And next year it's $200. What could have happened over that time period that could have made $100 become $200? Yeah. We could have just had prices go up, which isn't output. All right? So the way we measure real GDP is we're going to take we're trying to get some measure of how has quantity changed from year to year to year to year. So we have to figure out how to hold prices constant over time. Okay, so the basic way to create gross domestic product is to say we're going to try to figure out how much this is worth. And whenever you want to figure out how much something is worth, its value is always equal to price times quantity. Okay, so it has two variables in here. Remember last day when I talked about how much money you would have to buy in Canadian dollars to buy Canadian oil? And I said, well, there's two things that can happen. You might need more dollars if you're selling a greater volume of oil, and you might need more dollars if the price per barrel has gone up. So both of those can cause you to need to go to the bank and say, I need more dollars in order to pay for this Canadian oil. So when we're going to start to measure the value of something, we are measuring its market value and its price times quantity. And in order to make it, so this is going to be called nominal GDP, just prices times quantity. And real GDP is going to hold prices constant and multiply by quantity. Okay, so what we have to do is figure out how to hold prices constant over time, to say I'm going to use today's price for oil and keep multiplying it by different quantities over time. And if that number goes up and I'm holding prices constant, it must be that quantity went up over time. All right, so when we multiply price times quantity, we're getting bigger numbers. That must mean that we sold a higher quantity because we were making sure that it wasn't prices that were changing. Nominal GDP, I can't be so sure. If the number 100 became 200, it could be that prices went up, it could be quantity went up. But if I told you I'm keeping prices constant between these two periods, and I go from 100 to 200, that was all quantity. We know that that has to be true. So we have to do a little bit of manipulating. Okay, so how do we get at all of the nation's output? Well, when we're measuring the nation's output, there's a couple of kind of facts about how we measure in Canada to keep in mind. And so the first fact is that it is at market value. Okay, so when we want to talk about how many cars were made in Canada, we're producing Canada, gross domestic product, and we want to start with cars, and then we want to move to jackets, and then we want to move to oranges. Well, we don't make oranges in Canada, but let's say we want to talk about wheat, we want to talk about oil. We've got all these things we want to add up. We would say, okay, let's find out what the market value is for oil. What was the market value for wheat? What was the market value for hogs? What was the market value for computer parts? What was the market value for financial services? Okay, so we're going to find out how much did this stuff sell for when it was all over? And this market has to be final, goods and services. Okay, and there are markets for which it is not final. So for instance, let's say we want to take a look at bread. Let's take bread. So Weston is going to, so we go to the grocery store and we buy our bread. Okay? Well, there were a lot of kind of markets along the way. There was a farmer who made wheat, and so there's the value of the wheat. And then there was a bakery that bought the wheat and did stuff to it and sold bread to wholesalers. Then there were these wholesalers that distributed the bread to a bunch of retailers. And then there were retailers that sold the bread to the customers. Okay, now what if I said gross domestic product is the value of the wheat, the value of the bread, the value of the wholesaling, the value of the retailing, and then the customer, like the customer retail price? Why would that be a problem? Why would you go, oh, wait a sec. Yes? You got to be double counting, right? That wheat is there, and there, and there, and there, and there. We could have gotten rid of lots of gross domestic product if one company had own the farm and own the store. Then there would have been no internal buying and selling, right? So you can't increase your gross domestic product by just having more outsourcing and just say have more pieces along the way where it's done by different companies. What we want to do is we want to find out what is the value of the bread. It includes the value of the wheat. And so we only want either, there's two ways to do it. One is we can say, just take the final sale. Whatever that bread is, it's included the cost of retailing and wholesaling and transportation and wheat and farming. All of that's in there. It's all in there. Okay? It's included in the final, loaf of bread. Or we can say, let's just add value at every spot. So we're going to say the farmer makes the wheat, sells it to a baker. The baker says, how much do I contribute to the next phase? So what we'll do is we'll take whatever it is I'm selling my stuff for, subtract my costs. We'll subtract the wheat. So my extra value, the value I'm adding to the process, is the value of the baking. So it will not be the entire price anymore. It'll just be my extra contribution. So if wheat was $1 and I'm selling it for $2.50, I contributed another $1.50 to the process. So then the wholesaler says, oh, I bought all this bread for $2.50 and I'm going to contribute another 50 cents in terms of distribution costs and making sure it gets to all the grocery stores. So my value added, even though I'm selling the bread for $3, $2.50 of it was costs. I'm only contributing another $1.50. That's my value added. And then the grocery store says, oh, I bought all this bread for $3 and I'm going to sell it for $4.50. Well, if I'm selling the bread for $4.50, my additional contribution is $1.50. That's my value added. The $3 is cost to me. So if you add up at the very end everybody's value added, if you say, okay, the farmer contributed $1, and then another value added was $1.50, and then we add another 50 cents, and then we add another $1.50. If you add up all the value added, it will equal the final price of bread, which was $4.50. So there's two ways to get to $4.50. You just go to the final price, or you say to everybody, give me your value added, and I'm add them all together. It will also equal the final price. Why do we do this? We do favor doing value added. Can anybody think of a reason why going to the price of the final goods and service could have some issues? What could happen that could get rid of it? At the very back.
If we outsource to different countries?
Well, we can keep track of it if we sell it to somebody at the border. So we can keep track of that if we sell it abroad. Yeah.
If someone was selling at a loss?
Even if someone sells it at a loss, yes, we could have some value added that we're not keeping track of. The big concern is that what could people start to do if all we know is we're going to keep track of the final number, what might people do? They could sell it under the table, right? Then we have no final number. We have no number, right? If something gets sold and not through a market, then we never knew about that thing. We didn't know about any of the value along the process. So with value added, there's less under the table that you can hide, right? You can keep track of more steps along the way. Especially since in Canada we have HST, and HST is a value added tax. And the reason it's a value added tax, as opposed to we will just tax at the end of the line, this is how it works, the HST. The farmer charges HST to the next stage and then asks to get it reimbursed back. And then the next stage charges HST to the next stage and asks to get it reimbursed back. And then the next stage charges HST and gets reimbursed. The only player who doesn't get reimbursed is the final player, so that we know we're getting tax revenue on goods and services. But they do value added because what if you never tax the last player? What if you did it kind of under the table? We would have no taxes collected along the way. So that's why HST is a value-added tax. Everybody pays taxes no matter where you are in the process, intermediate, but you get reimbursed when you sell it to somebody else. So everybody who does books for small businesses will have net HST, what you paid versus what you're supposed to get back. And if you're early enough, you're getting it all back, right? You're not final. The idea of a sales tax on goods and services is it's supposed to be just on the final goods and service. But because we're worried about cheating, we do it at every step of the way with reimbursements. So it's a bit more complicated, but it's trying to get a stable tax revenue. All right, so it's final goods and services. The one thing where this is going to be important is when we start to talk about business investment. When businesses buy things, they are doing that because they want to make goods and services. But because if they buy capital, we think that that's so important, we keep track of it and say that that's a final sale. Okay, and another part of investment that we'll be looking at is when businesses have, say, cars in stock and they haven't sold them yet. They have inventory. So then what we do to say, but it was produced in Canada in this year, but we just didn't sell it. There was no customer who bought it yet. Then we would say, even though it's not a final goods and service, it's final at this point. It will next year be sold, but we count inventory as if it's a final good at cost. And when we look at governments who buy stuff, well, governments also produce services. But the governments don't sell their services. There's no market value on the price of, say, you going and getting your passport. All right? There's a passport office. You go get your passport. Yeah, I guess you do have to pay for that. Can anybody think of a service where you don't actually pay? Judge, say you go to court, all right? The fact that you get to see a judge or a police officer. A police officer stops you. Usually don't have to pay for the right to have this service where the police officer comes to your home if you've been robbed. You don't usually pay the police officer for showing up, right? Thank you. I've been robbed. Can you please investigate? They just, or there's a fire. Firefighters show up and they hopefully put out your fire. All right, well, how do we value the service of firefighting and policing? We do it at cost, what it cost us to hire these people. They don't turn around and sell their services for a profit, all right, because they're a government service. So we're trying to get money accounting for all of these things that are produced in Canada to say, in Canada, there was production, a lot of production, and a lot of players produced, all right, and we want to measure all of the value of all this production in Canada. And so there's basically, we need to get to final goods and services so we don't end up with this problem of double counting. It also has to be produced in the country. Okay, so trade becomes important here. If we make wheat and we sell it abroad, that is still part of Canada's gross domestic product. If we consume oranges but they weren't made here, they're not part of our gross domestic product. But when I keep track of my groceries, my grocery basket has bread in it and oranges in it. And it might have strawberries, you know, blueberries from Mexico. Okay, so my basket, if we're going to keep track of what was bought, my basket's going to have stuff that was made in Canada, not made in Canada. Gross domestic product is the amount of stuff that was made in Canada. So what we have to do is add exports. It was made in Canada, but no one bought it here. So what's that number? And then we import, we have to subtract all those. Because yes, it was bought here in Canada. It's part of somebody's, you know, bill. But it wasn't made in Canada. It's not gross domestic product. So we subtract all our imports. And businesses can import. Governments can import. So we can have imports from all over the world by any agent in the country. And we say, that wasn't produced in Canada. We have to subtract those numbers. So gross domestic product is got to be product that was produced in the country. There's another measure called gross national product. Gross national product is, well, gross domestic product is all of the product produced on domestic soil. Gross national product is all of the product that was produced by a Canadian, a national. That Canadian or national might have a company in Indonesia. If a Canadian company produces in Indonesia, it is not counted in gross domestic product. It is counted in gross national product. If in Canada an American or Chinese company is mining, let's say, that production of gold or potash or nickel or whatever is counted as gross domestic product because it was made in Canada, but it is not included in gross national product because it wasn't it was made by owners who are not Canadian. Okay, so that's the difference between the two. The most common form of measuring output in a country is now gross domestic product. That tends to be what everybody uses. But there are other measures, and I just want to highlight that. And then the last thing, it is for a period of time. Okay, so when we measure gross domestic product is usually, you can get data that's quarterly, you can get data that's annual. It's like, what was the production in Canada for the month of January? Okay, so it's over a period of time. Most numbers that we're going to get from Statistics Canada will be annual. What was gross domestic product in 2017? Okay, those numbers will be coming out soonish. All right, so we're going to find out how much was gross domestic product last year in the country. So it's for a period of time. So gross domestic product is typically, it's a flow variable. Okay, a flow variable says I'm measuring beginning to end, what was the production in the country over the year? How did it flow? As opposed to a stock variable. So let me just take personally. So when you have a job, you're going to get a wage or a salary. That's a flow. If you save some of your salary by putting it into a bank account or into stocks or bonds, it will start to accumulate over time. And at any point, it's still sitting there. That is a stock, right? So you can start to say, I always have this stockpile of income that I didn't spend. So my savings are going into the stockpile, but my consumption is a flow. I consumed it as I went. All right? So savings in a particular year is a flow. I'm saving a certain percentage of my income this year. It goes into this pile, and this pile is called wealth, and wealth is a stock. So my wealth is usually a stock variable, and my income is a flow variable. All right? So, and my flow affects my stock. So if I start to save more, my stockpile of wealth goes up, and when I save less, I am starting to see I'm going into my savings and I'm spending my savings. My stockpile of wealth is decreasing. So income is a flow variable, and it's over a particular period of time. Okay, so that's kind of the general rules. How do we do this? Well, let's just take a look at the sort of two ways to think about it. And what we're going to do is have what is called the circular flow. Okay, so a circular flow says, I mean, this gets kind of complicated, and it takes a lot of statisticians to try to get these numbers right. And so what we're doing is we're going to say, let's think about how the economy works. So this is how the economy works. So we'll start with households. So we have households at the top. That's where all of us live. Even if you are a small business owner or you are a CEO of a corporation, you live in a household. And there's two things you do as a household person. You can offer up into the factor market. So we're going to have factor markets, which are factors of production. So you've got a couple of factors. What are factors that households have that they can offer up into the market to say, here, I've got stuff, I'd like to put it out there. I like to supply these factors. What would be a factor? Yes. Labor. I could say, I'd like to work. I'm now old enough to work. I would like to provide labor hours, so it's a factor of production, and I'm offering that up to a business to say, I'd like to work. And the business says, thank you. Yes, we'd like you to work. We want you to do stuff, be productive. You're going to make goods and services, and then we are going to offer those goods and services to the goods market. Goods and services. So, factor markets are the inputs. Goods and services are the outputs. But households also offer more than labor. What else do households offer to the market to say, I've got some time, but what else do households have?
Do you think households offer money as well?
Okay, they offer their savings.
Taxes.
They offer their savings. They say, you know what? I have some stuff left over that I didn't spend, and I'd like to save it. And so I'd like to save it in a number of different ways. So what are ways that households actually try to save? And the reason they want to save, why do any of you want to save? Like, what is the point of saving? What would you do with savings?
When you retire.
Pardon? Okay, but what does it mean to have financial security? What is it you hope to do with these savings? So I'm in the time of my life where I am saving frantically. And why am I saving? At the back. Well, I have missed 40. Yes, I am not retiring by 40. So, yes. Yes. You save it so you can spend it later. So savings is what's called intertemporal consumption. I'm trying to smooth my consumption out. So I'm going to consume a little less today so that when I'm old and I'm not working, I have something that I can consume. All right? So I want to become I'm a lender. Okay, and how do I lend? Well, how do people lend? How do you save? How do people save? Yeah. Yeah, how do you, now we call this invest their money. Okay, so what does it mean to invest your money? So this is where macro is going to get a little confusing because we're going to use the same word in two ways, and one is actually technically correct to an economist, and the other is the way everybody uses it, so we kind of have to know the difference. Technically, nobody in this room is investing money. Unless you happen to be a small business owner and you bought, say, some equipment, then you invested. So in a macro course, investment is always in real capital. You bought a bus. You bought a taxi cab. You bought a machine. You got some software, okay? That is considered an investment if you are a business. But you guys are households. Households don't invest. What they do is they give financial capital, which is their savings. And how do most of you save? How do you do it? Like, how do you physically save? Yeah?
Well, you can physically save just by transferring money to a bank.
Okay, so you might have a bank account. You might go to your bank account and you might say, I'd like to open up a tax-free savings account. All right, so you've got a tax-free savings account going. Or you might go to a financial planner and say, I'd like to buy some mutual funds. And so I want you to take money out of my account every month and I want you to invest it, with quotes, in the stock market through some mutual funds. Or you might be really savvy in terms of the market and you go, I'm buying my own stock. So you now have gone to your bank, which actually has a capital markets branch, and they've got really low rates. And what you're doing is you're saying every month, or you're watching your portfolio and you're going, oh, I have a whole pile of bank stocks. I think banks might be risky right now. I'd like to offload them and buy some pot. You know, I want to buy some shares in the marijuana market. Okay, I think that might be a good one. All right, so I'm actually moving between shares. This is not what I'm recommending any of you do. I'm just using this as an example. All right, so and what you've done is you've gone to a market where businesses have said, you know what, I think we want to do something real. We want to expand our market, and so we're going to need to build another factory. Well, we don't have the capital to build another factory, so what we're going to do is either we're going to go borrow the money from a bank, and the bank says yes or no, and what are they going to do? Well, they're going to go to you, who all have these deposits at the bank. They're going to combine them together and say, you need a $5 million loan. Okay, we've got lots of depositors. We'll take their money and lend it to you. Okay, so we'll lend you money. Or they're going to go, no, we don't. Too risky, we're not willing to lend you the money. So what we're going to do instead is say, all right, I think this is a good idea. I'm going to offer you shares in the company. So I'm going to give you part ownership. And then I'm going, okay, this looks like a really good business. I have a friend who was offered shares in RIM when it was starting because he was a student with Lazaridis, but he didn't have any cash. If he had just bought like $100, it would have really he would have been a really rich guy. All right, but at the end, you didn't know this was going to be successful. No one knew the BlackBerry was going to do what it did. So beforehand, you're guessing. But if you think it's a good idea, then you just put your capital, your savings, and you're hoping you're going to get this big return. Okay? So basically, households are taking their savings and, in quotes, investing it in businesses. And they're doing it usually indirectly. They're doing it indirectly through financial institutions who collected your cash, and they are distributing the cash to those who need to borrow. Okay? So we have a huge financial sector in Canada, huge. It's one of the biggest employment areas in the country, working in finance and real estate. All right, so this is a kind of a big deal, and all they're doing is they're connecting savers with investors. Okay, financial capital with physical capital. And they're letting these two parts, and they are providing the security in the middle to make sure that this borrowing and lending is fine. Okay? Then what happens? So we've got these players, then we've got businesses. And so the way we're going to measure all the stuff that was produced in Canada is we're going to go to businesses and say, you sold all this stuff last year. Okay, who bought it? Let's add up everything that was bought by different players. So who are the big buyers in, say, the Canadian economy? Who goes shopping? And will be a big buyer of Canadian goods and services that are produced in Canada in this year on Canadian soil as a final good and service. So who do you think is the biggest buyer of goods and services? Households. And what do we call you if you're in a household and you're buying? You're a consumer. So consumption is the biggest of all the buyers in the Canadian economy. But consumers are not the only buyer. Who else goes shopping and buys stuff? Yeah.
Doesn't businesses go and buy stuff to manufacture products?
If businesses buy stuff like toilet paper or pens, it would be included in the cost of their doing business. So then whoever bought their final goods and service would have captured that cost. What we include for businesses is the stuff like capital. They bought a machine. Okay, yes, that machine's going to be used to make their final product, but this machine's such a big deal that we're going to give it a category. So if businesses buy capital, we call that a final sale. Okay, so if a business buys a photocopier, that's a final sale. Okay, if who else would go shopping and buy stuff? So we've got consumers who are buying stuff. We've got businesses that are going to buy capital. And it's only capital that we count. If they buy toilet paper, or they buy paper, or they buy pencils, or they buy toner, ink, that is not included. That's part of the operating cost of doing business. That cost is getting passed on to whoever buys their product. But we do include anything that they classify as capital. What do you get, any accounting students here, what do you get to do, if something's classified as capital, what do you get to do against it? You get to depreciate it. So there's a capital cost allowance against capital. So there's rules about what you can count as capital. If it's capital, we count that as gross domestic product. Who else goes shopping? Other countries. So if we have foreigners who are buying our goods, we call that an export. We want those numbers to be included because even though it wasn't consumed in Canada, it was produced in Canada. And we want net. Okay, so if it was produced elsewhere, we want to subtract that if it was consumed here. So consumption can be really huge, but it could be stuff that was not made here. We want to take that out because that's not part of gross domestic production or product. Okay, and who's one more player? Who else shops? The government. The government buys stuff, right? They buy buses, they pave roads, they build universities, like they give money for roofs, all right? I remember one year, it was part of the infrastructure spending after 2008. This building was completely renovated. This did not look like this. It was dark and it was quite grim. And the roof had to be redone, and you had to have this spending that was really fast. They had to have it done by March. So basically, the entire time I was in this class, you would hear drilling on the roof. Through the whole lecture. It was like torture. It was like torture. So finally I complained, and then they moved me to East Residence, and we had it in one of their lounges. I was lecturing in the lounge because this building just couldn't be in here. And they had to do it or they wouldn't get the money. I mean, it had to be spent by a certain time. So governments spend money too, all right? And we keep track of that. Okay, so once everybody goes shopping, that's one way of looking. Gross domestic product is based on who all the shoppers are, and let's add them all up. There's another way to look at it. Let's say I take a look at this coat. I just got this coat. Whoever said that parkas are cool looking, bless their heart, because everyone has one of these, and like this is new. Like notice that everybody's wearing these parkas. And it's just like in that bitter cold, it was so wonderful, and it's considered fashionable, thankfully. All right, so here's my parka. All right, it's made by Moose Knuckles. Okay, so here we have a Moose Knuckle parka, and I think they're Canadian. All right, so it's gross domestic product here. So here we have this parka, and I bought it. Okay, so they made it, I bought it, I'm a final consumer. Goes into gross domestic product. Okay, they received the parka. They sold me the parka and I paid them. What do they do with the money? When they get paid for parkas, what do they do with the money? On what? I mean, if I'm a company and I have this revenue coming from all my parkas, what do I do with my revenue? I got to do something first. Like, how did this get made? Yeah. I got to pay my expenses. And what are my expenses in making parkas? There's cost of materials. All right, so there's down in here. All right, so I got materials. What else is in here? What else was used to make this parka? Yes? They probably needed electricity, so there was utilities to make the parka. What else? Yeah. Wages and salaries of the people who were working on the machines to make the parka. And there were machines, right? So they had bought these machines in the past, but there's maintenance on the machine. These machines are depreciating, okay? So we have to add back, like what was, how do these machines have to be kept up? Okay, what else do they do? Yeah?
Rent.
Pardon?
Rent.
They pay rent, okay? They paid rent. They maybe had shareholders, so they have to give their shareholders some dividends. Okay, maybe it's an owner, so profits have to go to somebody, okay? So it might be that you're distributing the profits through a dividend payment out, if this is a publicly funded company, or if it's a small company, they might just give everybody who's an owner of the company, a dividend, or a profit share, okay? So, technically, whatever I spent on this coat got into somebody's hands when it was over. Whatever this coat is worth, somebody got paid from it. We could break it into who got paid. So if I could account for all the income that was generated from making this coat, it should equal the value of the coat. So there's two ways to measure gross domestic product. Okay, one way is called the expenditure approach. Let's just add up all the shopping. The other is called the income approach. Let's just measure everybody's income. And the broad categories look something like this. And I have to admit, this is like the accounting section of the course. The one which I did not become an accountant for a reason. It was not my interest. And so what we're doing is we're trying to keep track of these two approaches. So the expenditure approach, you can see what are the main categories. Well, we have the first thing called a statistical discrepancy. Well, the statistical discrepancy is basically the same number on both ways of doing it, because it turns out when you add up all the income and you add up all the spending, they don't exactly match. So what they do is say, let's take these two numbers and split the difference. So gross domestic product in this case, if you're using the expenditure approach, is actually above average, and the income approach is below average. So somehow, when we use the expenditure approach, we actually get more numbers than when we use the income approach in this story, okay? And so when we're using the expenditure approach, notice that we subtracted the exports, okay? So we have net exports, so we have exports minus imports. So what is that telling us in Canada? Our net exports are negative, so what does that mean? What do we do more of? Yeah? We're running a trade deficit. Yes, we export less than we import. So this number is a negative number. So we are not a huge, like we are a huge trading nation, but on net, it's like half of our income leaves the country and half of it comes back, all right? Because we're north-south, right? So it's half, half, but when it's all done, we're in a deficit. We actually bring back more than we sent out. Even though the volume of exports and imports are huge on net, it's actually not that huge on net. Then we have, in terms of capital investment, we're going to just look at businesses and what they do. And there's basically business investment and government investment is basically three kinds of items. I feel like I have feedback happening here. Okay, so we have basically three kinds of items that would constitute investment. What is investment? Well, what would be a logical thing to say? Well, this has got to be investment. What would you guess if a government does it, or a business does it, or a not-for-profit does it, they buy this, it's investment. What do you think would be investment? Equipment. So plant and equipment, if they decide to build a building, okay? They build a building, that's got to be an investment. They put in some equipment, that's got to be investment. So investment can be done by the government. If they decide to put in a fast rail service, that's investment, right? That's not consumption. They're not purchasing, the cleaning supplies to clean out, say, the Parliament buildings. That is not investment. That's just as-you-go spending. An investment would be if they actually put a wing on a building, build a hospital, that's investment. Okay, so businesses can invest in plant and equipment, governments can invest in plant and equipment, not-for-profits can invest in plant and equipment. That's investment. Another category is consumers who invest in houses. So residential construction is considered an investment, not a consumption. So if a new house gets built, it's put under investment, not under consumption, because this house is going to last for a while. So it's as if the developer is spending the money, not the consumer. All right? So, but if I sold my house, would that be a change in investment? I have a house that was built in 1959. If I sell my house, is that, and I buy a new house, and I buy another house, is that a change in investment? My house has gone up like 4 times. Like from what I bought it for and what I'm selling it for, is that like investment because my house has gone up in value? Would we count that as gross domestic product, that suddenly this house that was selling, 30 years ago at 100,000 is now worth 600? Okay, is that investment?
Yes.
No, it's not. Why wouldn't it be? It is, I am wealthier, for sure, I'm wealthier. It changed my net wealth, but why is that not going to get included in gross domestic product, the sale of my house? Yes?
The price has to remain constant?
We will have the price has to remain constant, true. And why would I still not care about the house? Yes?
It's not produced in this time.
It's not produced in this year. It's an old house. The only thing that gets added to gross domestic product in this year is that there was a service that was provided if I sell my house. I have a broker or a real estate agent who got paid. They provided the service of selling my house. They advertised my house. They brought people through my house. So in that case, whatever was spent on selling my house would be included in gross domestic product. But the house is not. It has to be a new house. It has to be a new house that was built this year. Those are the only houses that are included in gross domestic product. Old houses were built in another period. Okay? And then the last part of capital that we want to take a look at is what's called inventories. So let's say you're Ford and you have all these trucks in the lot. How many of you have ever been part of doing inventory anywhere? You've gone in and done the counting. Okay, so you think, why do they have to do this inventory? They do inventory because at a particular point in time, we want to know how much is in stock that wasn't sold but was produced this year but not sold this year. We count that as investment. It's investment because you are going to use it to run your business. And you would then use it as, you would be listed at the price that you have on the ticket, the sale price, which hasn't been sold yet, but it would be valued. Okay, just guys, I've got 5 minutes. So, right? Is that clock right? Yeah, so don't move. Okay, don't do that. All right, so when we're doing investment, it classified by these particular kinds of spending. So we've got consumption. We have the government who consumes, right? They do buy cleaning supplies, all right? And we would use that as part of government spending as consumption, and we don't then try to figure out what was the value of the service that the government had because they didn't sell their service of having a parliament. All right, we just say, this is how much the MPs cost, that's how much they cost. All right, that's part of gross domestic product. So basically, when we're doing the income approach, what we would do is we would add up all of the income to all the players. And when we do the expenditure approach, we do all the spending by all the players. And these numbers should match each other when we're done. The only trick, and I want to point this out because you'll need it later, is let's say that you guys get OSAP. All right? What would that do to gross domestic product? Okay, so we have to figure out, where does OSAP come in? All right. If you get OSAP and we're using the expenditure approach, where would we see your OSAP? Would it be under government spending? Did the government spend when they gave you an OSAP check? So let's think about what this is. Where did they get the OSAP check that you got? Where did they get it from? They took it from me, right? Because I paid taxes. So I paid taxes, it went to the government took it and gave it to you. And I'm totally fine with that, no problem. However, did the government spend? No, who's spending? You are. With your OSAP, you're going shopping. So transfer payments are not government spending. They just change who the shoppers are. So government spending has to be, they actually bought cleaning supplies. They bought paper. Anything that is like old age security, welfare, employment insurance, OSAP, none of that is government spending. That is an income transfer from one group to another group, and you change who the shoppers are. Okay? All right, we will pick up from there next day.